So welcome to this video. In this video, we are going to discuss about business valuation. So we'll discuss about what is valuation. So valuation is an analytical process of placing a value on a company based on its assets, current and future earnings and cash flow generating capability. So we need to value a company's share so that we can decide on like buying the share or selling the share, or in buying a company or selling a company. So to do any of these things, buying and selling of a company or a share, we need to find the value of the share or the company. So to determine this value, we do a process. Okay, there are like various methods to find out the value, and once we have found this value, it is called as intrinsic value. So valuation is a process of finding out the price for a company. So in this slide, we look at why valuations are required. So a share valuation will be necessary for the following things. For example, to buy and sell a share, an intrinsic value is useful. For example, we'll put like this. Assume that there's a share price. Okay. So the share price moves from up, down and up. For example, the highest point of the price is 200 and the lowest is 50. And again, the company reaches 200. So when will you buy and when will you sell? So you can't tell like I will buy the share at 50 and I will sell the share at 200. That does not work, because you have to find out the intrinsic value of the company. So assume that the intrinsic value we have found and it seems to be 100. So 100 is the intrinsic value of the company. So what happens is, anytime it is below 100 you can buy, and anytime which it is above 100 you have to sell. Okay, so the buy and the sell are predominantly dependent upon the intrinsic value. To find out that intrinsic value, we have to do valuation. So valuation becomes very important. So the next one is merger with another company. So here what we try to do is, we assume that you are running a company. The company is called as ACO, and you want to buy another company. It is called as ZCO. So ACO, your company is a listed company, and ZCO, it's a unlisted company. So what you do is, you try to buy ZCO using your shares. Okay, so your share value, your share value is 100 rupees, and you don't know what is the value of the other company. So what happens is, you try to value the ZCO. So ZCO valuation you have to find out through the intrinsic value. So if the intrinsic value of ZCO is 50 and the intrinsic value of your company is 100, what you do is, you try to buy the ZCO's share in a kind of a ratio. So the ratio would be like this. If the valuation is 100 is to 50, then for every 2 shares of ZCO, you give 1 share of your company, ACO. Okay. So even in times of merger, valuations are very useful. So the next one is, shares need to be valued for the purpose of taxation. Shares are pledged as collateral for a loan. So just like we get a loan by pledging stock, okay, or inventory or fixed assets, we can also give shares of a company as collateral. In that times also we need valuation. Even at times of diverse settlements, so the husband and wife will try to find out what's the value of a company which they are holding, and they try to divide it accordingly. So valuation is also used for an unquoted company. So we also saw an example in terms of the merger. So that was an example, but we can also apply it for an IPO or a private placement. So an IPO is the giving the company's share or selling the company's share to the general public And private placement is selling the company to few institutional investors. Okay, so these are the two things. So at any point of time, if you want to sell your company either partly or fully, you need to value the company. So these are the situations in which valuations are necessary. In this slide, we look at what are the various information which are required for valuation of a company. So the list which we are going to discuss is not exhaustive, and there are like various types of information that can be used to value a company. So we'll just see a few of the information. So one is the financial statement. So we can use the annual report. From the annual report, we get the financial statements. So within financial statements, we have the statement of financial position or profit and loss, changes in equity, cash flow, and disclosure notes. So with all these information, we have the numerical data. With this numerical data, we can use it for quantitative analysis. So number wise, we can find out what is the intrinsic value of a company. Okay, but this is only a part of the information. We need another part of information. For example, we can also get information in terms of background information on the industry in which the company is, or the company's competitors, information about the management, how good they are, how ethical they are, and how talented they are. We have to get information. We can also get other reports in terms of CSR, environmental, chairman's report, auditor's report. These information are called as qualitative information. In these qualitative information, we cannot find out the intrinsic value. Okay, it cannot be found. But if you have quantitative, the qualitative adds much more betterness. So it both quantitative and qualitative gives you a better idea about the intrinsic value of a company. So in this slide, we look at what are the various methods which are available for valuation. So number one, we can use the market capitalization as a method. Number two, we can, based on the assets of the company, we can try to value the company. 3 is discounted cash flow base. So based upon the cash flow of a company, we try to value it. Or income based method, based on the returns and income generated by the company, we can value them. And also based on the dividend, we can use the dividend valuation method. So these are the 5 methods which are there in your examination. But still in reality, there are like many methods which are available, and each method has its own pros and cons. So even in our exam, you have to remember like what are the pros and cons of each method, and where these methods can be applied, and for which companies it's like useful to apply. So you need to understand all those things. So we'll have a note. This is in terms of your examination. So this note is applicable for all the methods. If you are asked to value a business, check the wording of the question carefully to establish whether you are being asked to estimate the value of the business as a whole or a per share. Okay, so be very careful whether they are asking for the whole company or for a per share, which one they are asking. So be very careful with this. If you are asked, if you are required to value a unquoted company, okay, a unquoted company using a listed company, then take 50% to 60% of the resulting value for the unquoted company. So if you are using a listed company to value an unlisted company and you used a method and you got a value, out of that value take only 50 or 60% and get the value for the unquoted company. Okay, so the question itself will mention whether it's going to be 50% or 60% value that has to be taken, or if the question is not giving you, you have to assume some number, okay, 50 or 60, and arrive at the value. So this is a very important note from the exam point of view. So we'll start from the first method. We'll start from market capitalization. So market capitalization refers to the total market value of a company's outstanding shares. So this is also called as market cap. So how it is calculated, we have the formula. The investment community uses this figure to determine the company's size, okay, how big the company is, as opposed to sales or total asset figures. So what is market capitalization? Market capitalization is the total shares outstanding, okay, total shares which are in the stock market multiplied by the current market price. Okay, so that's how it works. So the total shares outstanding means the word outstanding refers to the number of shares in the stock exchange, okay, that shares alone into the current market price. That will give you the market capitalization. So for example, if you take an Indian company, TCS has 197 crore share, and assuming their price somewhere it is like 2500, their market capitalization is 4,96,000 crore. If you take Reliance, their number of shares is 325 crore, and the current market price is 1300, and the market capitalization works at 4,22,000 crore. So we look at Apple. Apple has 517 crore shares. Each share is worth around 9,240 rupees. And if you multiply, it comes to 47 lakh 83,000 crore. Okay, but look at their share price. Their share price is 9,240. How large it is. But there's another company called as Berkshire Hathaway. Compared to Apple, they have only 13.6 lakh share, okay, 13.6 lakh share, but each share is worth around 1 crore 72 lakh 26,000, and multiply it, you got the market capitalization. Okay, so it works like this. It's not about the current market price being higher or lower. To what is like very important is what is the worth of the company. The worth of the company is determined through the market capitalization. Okay, so that's how it works. So we'll move on to the next method, net asset valuation method. So the net asset method provides a lower limit for a company's value. So when you apply this method, you will get a lower limit of a company, or the minimum worth of a company. So this gives you the minimum worth or minimum value of a company. So the formula works like this: NAV equals to total asset minus the goodwill and minus total external liabilities. So you take all the assets of your company, reduce goodwill. Why we reduce goodwill? Goodwill is a fictitious asset, so it is not an asset at all, and minus all the liability in your company. The resulting is the net asset value. So to find out this is a net asset value for the whole company. If you want to find it for per share, you use NAV per share. That is, take the NAV which was computed here and divided by the number of equity shares, you will get at the NAV per share value. So application, where can we use this method? See, this method is useful for companies which relies on the assets to run the business. Okay, what kind of an asset? Mostly it is like tangible assets. Okay, not intangible, tangible assets. For example, car manufacturing company or a mining company, where it is not useful. This method is not useful for a service company such as a travel and ticketing agency or an education company or a software company, because for these companies the intangible assets are more. So we can't use the net asset valuation method. Even if you use, the value will be very absurd. Okay, so this method can be used for a company which relies heavily on the tangible assets. So we look at an example. So this is an example of Bajaj Auto. For example, take the total assets of the company, which is 2,928,929. So that comes to here. Then we have to check the goodwill, deduct the goodwill. So goodwill is not here. Usually you have to less the goodwill. Goodwill is not in this table, so we'll take it as 0. Total external liabilities. So total external liabilities comes as here. These two things add together, you would have got this number. Okay, so reduce both, you got your NAV. Okay, 223,4. You can also get that the same number by adding share capital and reserve. So if you just take these two numbers and add, you will get the same answer. Okay, so that's how this method works. So on what basis can we do asset valuation? Value attached to an individual asset may vary considerably depending on whether it is valued on a going concern or a breakup value. Okay, so you can use this method in various ways. For example, if it's a going concern, then the value based on NAV will be different. If you are going to use breakup assets, assume that the company is closed and all the assets are sold as an individual piece, then the assets are valued in a different way. So even if you use this method, uh, what the company is going to do creates a NAV value very differently. Okay, if it's a going concern, the NAV will be different. If it's going to be, the company is going to be closed and the assets are going to be sold, then the NAV will be different. Okay, so we look at like this. We can use the asset value based on the historical cost method, but this will not give you a realistic value of the assets because the asset might have been depreciated and amortized. Okay, so this value will be always very low. So we'll move on to the next method called as a realizable basis. In this method, the assumption is the assets are going to be sold either or the business as a whole is going to be broken up and then sold each asset on an individual basis. But this method is not such a good method to value a minority or a non-controlling shareholder because he cannot sell the assets on an individual basis on his own. Only when the majority shareholder decides, that is like possible. So to value a minority shareholder's share, this is not a appropriate method. And also you shouldn't use this method for a going concern company. If a company is like going to be operated, then using this value is not an appropriate method. And third is the replacement method. So assuming that the business is going to be continued but based on a new set of asset. For example, we constructed a factory and the factory was constructed a very long time ago and it is like now worth only 100 crore, but to create a new factory in similar capacity and in similar operation will take 200 crore. So we can say that the company's value is between the 100 and 200 crore because if you want to create a factory now, it's 200 crore of amount. So we should be like again, this method is very subjective. So intangible assets including goodwill should be excluded unless they have a market value. For example, patents, copyrights which could be sold. Okay, so only when a intangible asset has a market value, it should be included. If it's going to be a fictitious asset, or if it's going to be intangible asset generated by the company, then those kinds of intangible assets should be ignored. Development expenditure, if shown in the financial statements, could also have a value which is related to the future rather than to the worth of the company's physical assets. Hence, it should be excluded. So, if there's going to be any development expenditure, then that value should also be excluded. So, NAV method is very applicable for to find a minimum value of a business. We've already discussed this. For asset stripping, if the assets are going to be sold on an individual basis, then this is useful. To value a property investment company, so if a company has a lot of properties, land, buildings, or mining, these companies, it's like very useful. And to value asset based companies such as mining, this is a very appropriate method. So what are the drawbacks of this method? NAV method actually ignores the following very important things. For example, it ignores a highly skilled workforce, highly motivated workforce, the strong management team, the superior products compared to competitors, the brand value. So all these things are like ignored. So the problem is it only takes the assets into account. That is the problem. So we'll see the actual implication of this problem. If you take this company, again it's a Bajaj company, the market value, the market says that the value of this company is 91,000 crore. But when we do the NAV value, it comes to 23,000 crore. So look at the difference. The market says the company is worth 91,000 and the NAV method says the company is what, 23,000. So the difference 91,000 crore minus 23,000 crore, look, comes to 68,000 crore. Okay, where is this difference? The difference here is because for the brand, it is for the product, it is for the future outlook. Okay, so none of these things are considered in the 23,000. The 23,000 is only for the asset, but for the company, as a running company, the market is giving it a value of 91,000. If you even check in reality, the value of, I think like 95% of the companies which are trading will have a more value than the NAV. Okay, so that is how NAV methods are. So we'll have a quiz. So this was asked in September 2016. The finance director of Rinco has been advised to calculate the NAV of the company. Which of the following formulae calculates correctly the NAV of Rinco? Total asset less current liabilities. We are not considering the long-term liability in this formula, so this is wrong. So non-current asset plus net current asset. Again, we are not considering the long-term liabilities, so this is wrong. Non-current asset plus current asset minus total liabilities. So this considers the total liability. So total liability is current liability plus long-term liability. So this is the option. We'll check D also. Non-current asset less current asset. No, we should not be like lessing the current asset. We should be adding the current asset. So this is the right option. D is also wrong. So the answer should be C. The answer is C. So we have another question. Asset-based model is applicable for valuation for which of the following firms? An oil drilling company that is not operational and has not found oil in places where it drilled. That is, there is no future income and all. Okay, what is still there is only a machine, and that machine is also not like currently used. Yes, we can use the net asset value for this kind of a company, because the only thing that they have is the driller. A software company that launches gadgets with cutting edge technology. So a software company has a lot of intangible assets. So for for a company which has more intangible asset, net asset method is not a right method. A textile manufacturing company in a country that is experiencing high inflation. So this is not useful, because in a high inflation country, the worth of money keeps going down and the value of machines and assets goes up. So it's very difficult to balance both and try to find out a value. So I think A should be the answer. So the answer is A. So we have another question. When valuing Bluebell Co. using asset-based valuation, which of the following statement is correct? An asset-based valuation would be useful for an asset stripping acquisition. Yes, we saw the exact word earlier. Bluebell's workforce can be valued as an intangible. Workforce can never be valued, and in NAV method, it can never be valued at all. So B is wrong. C. Asset-based valuation considers the present value of Bluebell's future income. This is not the right method. That method is called as DCF, discounted cash flow method. So C is again wrong. Replacement cost basis provides a deprival value for Bluebell Co. So deprival value means it is the most lowest value that can be arrived. Actually, it's not replacement. Replacement actually gives you a higher value. If you use replacement for NAV, it gives you a higher valuation. But if you use realizable, that gives you the low valuation for NAV method. So again, this is wrong. So the answer should be A. So we got the answer. So the next method is called as income-based valuation. This is an appropriate method of valuation when a substantial part of another company is bought, as majority shareholders can influence the dividend policy and earnings. So it is useful when we are trying to buy another company and we are trying to become a majority shareholder, because the shareholder will get and can influence the dividend policy and the earnings. So in those cases, income based valuation is used. So we will use this method. It's called as a PE ratio method. So the PE ratio method works like this. PE refers to the current market price of a share, or the price of a share divided by earnings per share. Or we can also use this formula: the market capitalization of a company divided by total profit after tax and preference dividend. We can use this as an alternative formula. So if this information is given, you can find it through this formula, or if this information is given, you can find out through this formula. So either way you do it, you will get the same answer. So we'll see like what is a PE. This is Amazon company's information. So if you look at the PE, it is at 180. Okay, so 180 refers to the share price of the company is 958 divided by the earnings per share is 5.34. It gives you an answer of approximately 180. We usually tell it as 180 x. X refers to times. So in short, it works like this: 180 is divided by always 1. Okay, it refers for every 1 rupee earnings of the company, the share price is trading at 180 times. So it will take, if the company is earning 1 rupee per year or $1 per year, it will take 180 years to recoup the share price. Okay, So why are people willing to pay 180 times for a 1 rupee? Because they feel that Amazon is an amazing company, it can grow a lot, and they feel that this EPS number can grow tremendously. So even if the price is at 958, they feel that this 5.34 EPS can go high. How much high it could go? They feel that it might even go to 95.8, at which time the PE can fall to 10. So what they feel is, they feel that the earnings per share will increase tremendously over a period of time. So that is why they are willing to make a bet of 180 times for $1 of earnings. So this can then be used to value a share in an unquoted company. So the value of a company we can use as a total PAT into PE, or that gives the total value of the company, or you can take the EPS, multiply it by the PE ratio, you get the value per share. So note, using an adjusted PE multiple from a similar quoted company, you should use another similar quoted company, another company's PE to value your company, and that PE should be adjusted. So we'll look at a problem. So again, it works like this with the common note which we already saw. Okay. So to get the PE value of unquoted company, you have to take the PE of quoted company and multiply that number by 50% or 60%. So this is your choice, you can take any number, but this has to be done. So you can use another company's PE to value a unquoted company. So we'll see an example also for this. So assume that there's an unquoted company called as company Z. This company is like very similar to Amazon, and the company has a EPS of $1. So we also know that the PE of Amazon is 180. So what we do is we try to value the share of Z with Amazon, as both companies are like similar, but Z is an unquoted company, we have to get a value for it. So what we do is, the formula was earlier EPS into PE. So to value the PE of an unquoted company, we take the quoted company and multiply it by 50% or 60%. Here I have taken 50. So EPS into PE into the reduction. So now we will get the value for this company. So this company's value is $90. So I think you got an idea. There are like many problems with using a PE ratio to value a unquoted company. A single year's PE ratio may not be a good basis if earnings are volatile. So if the value of Amazon and its PE, okay, if are going to be in fluctuation, then we can't use Amazon's PE. For example, if Amazon PE is 180 at one point of time and 80 at one point of time, which PE will you take? That becomes a problem. Historical PE is used to find out the future value of an unquoted company. So what we do is we try to find out the historical PE. So what was the PE earlier, and we try to value the future value of a company. So we use past data to value the future. That in itself is a wrong. The quoted company should be similar to unquoted company. So we took an example of Zco and Amazon. So Zco should be very similar in terms of Amazon. In what terms? The activities should be similar, the products should be similar, customers should be similar, business model should be similar, and the capital structure should be similar. So is it possible to be similar in all the ways? The answer is no. So we should not use Amazon's PE to value Zco. So this also happens in reality, but what happens is in reality, even though there is no like a very similar kind of company, they use a very near company as a proxy. Okay, they take the very similar company's P ratio and they try to value a unquoted company. So that is how it works. So in this slide, we'll be like looking at when PE would be high and when it would be low. So PE would be like available only for a quoted company or a listed company. So PE would be high when a business is having a high growth rate, for example, Amazon. So Amazon has a very high growth rate during takeover bid. So when one company is being like trying to be bought by two other companies, the PE would be very high. And highly protected income, for example, like Unilever or Gillette. Okay, these companies will have a very high PE ratio because their income is always protected. So there's not much variability. So that's why PE will be higher. Expected good news for the business. For example, if the government is going to announce some kind of favorable policy, or the government is going to win a future order or an export order, in those times the PE would go up. So these are the reasons why PE will be high. So now we look at why PE will be low. So if a company is expected to incur a loss, then the PE would fall down. In terms of negative events occurring, for example, like labor strike or the factory getting burned, in those kind of negative events, the PE would fall down. If a company has an uncertain income pattern, for example, steel companies, okay, so if you compare two companies, for example, steel companies, over a period of like 10 years, this is on 10 years and this is their profit after tax. So steel companies will have a profit after tax like this, because in years of peak economic peak, the profit would go high. In terms of recession years, the profit would go down. So that's how it keeps on moving. But if you take a company like Gillette or Nestle, their earnings would not fluctuate to such a huge number. So if you take like Nestle, their price will be much more stable. That's why companies like Nestle will have a high PE, and companies like steel companies whose income pattern are fluctuating, they will have a low PE. And also, if a company has corporate governance issues, then the PE would be like very low. Okay, so these are the reasons. So now we'll have a quiz. So again, this is a specimen 16 examination. Which of the following statements are problems in using the PE ratio method to value a company? So he's asking what are the problems. It is a reciprocal of the earnings yield. Is it right? Yes. So PE method is a reciprocal of earnings yield method. This we will see later when we are discussing about earnings yield. So this is true, but this is not the answer because he's asking for a problem. It combines stock market information and corporate information. Again, this is true, but he's asking for problems. It is difficult to select a suitable PE ratio. Yes, this is the problem. We cannot find out another company which is similar to the company we want to value. So unquoted companies has to be valued on the quoted companies, but they have to be similar. But the problem is they won't be similar. The ratio is more suited to valuing the shares of a listed companies than unlisted companies. So if you look here, it is easy to value listed companies, but it cannot value unlisted companies. So that is what it says. The ratio is more suited to valuing the shares of a listed companies than unlisted companies. That is a problem. So the answer should be 3 and 4. 3 and 4 are B. So these are the problems. So the answer is B. So we have another question. What does a high PE ratio indicate to investors? Earnings have growth potential. Yes. If there's a high growth potential, it will be high. Earnings are volatile in nature. If earnings are volatile, PE will be low. So this is not the answer. Asset value is more than the operational business. Uh, it cannot be so. If it is like that, it says that the asset value is high and the operational business means the PE is less. The company is undervalued. If a company is undervalued, then their PE will might fall below. Okay, so the PE will be less. So the answer should be A, and the answer is A. Thank you very much for watching this video. We'll meet in the next video.